Section 8M, Comparing Strength and Weaknesses, Group Charts. Having completed our study of the composite average, our next step should be to acquire an understanding of group behavior because in practice, after we amine the position and trend of the various groups and finally select the best situated groups, those individual stocks which promises the best moves. If your trend charts are made on transparent paper, they may be laid over other charts of group or individual stocks to show which groups and stocks are stronger or weaker than the general market, as represented by the averages. Or you may make this comparison by laying one chart above another with the time scales in alignment so that each day of the week on one chart will be opposite and correspondent with the same date on the other chart or chart you wish to compare. The illustration which follow will make this clear. One of the best indication of the future course of a group or a stock is its comparative strength when the rest of the market is weak, or its comparative weakness in a strong market. James R. Keen used to say, watch the stock that shows strong resistance to pressure when the market is weak and buy those stock for all you are worth. Illustrated by action of US Steel from November 28, 1936 to March 6, 1937. See how steel shows stubborn resistance to every downswing in the market as represented by the New York Times average and how it responds vigorously to every upswings until March 6th. The reason for this, someone is trying to buy while the market is weak. He would not do this unless he has reason to believe that he can sell it later at a higher price. So he takes advantage of the weakness in the rest of the market by holding the bag for all the offerings of other people who are prompted or compelled to sell. When a stock is exceptionally weak in a strong market, we conclude that somebody knows something to its disadvantage and is forcing his offering on a market that is otherwise strong. This may indicate need for urgency based on fear or necessity. It may signify the taking advantage of strong market. The chart of American can illustrates this idea. From November 17 to December 12, 1936, the stock responds feebly to rises and advances in the market, but shrinks rapidly with every downswings from January 9, 1937 onwards. It is again exceptionally weak. Large operator often test the market for a stock by buying 5,000 to 25,000 shares in order to see how easily they can buy it or selling a similar quantity to ascertain how well the market will absorb the selling. Thus, they are able to decide which side shows the least resistance. If they find other people are trying to buy it and that the stock is rather scarce, they regard it as bullish indication and take a long position. Or if the price yields easily to pressure, they regard it as bearish indication and take a short position. A small operator is unable to test the market in this way before he takes a position. But by a close study of his charts, he is able to estimate the comparative strength or weaknesses of a stock and thus reinforces his judgments as to whether, considering the trend, it is time to buy or sell it. When large interests are planning a campaign in a stock, they lay the foundation. That is, they accumulate or distribute a quantity according to the size of their ventures and they anticipate profit to derive therefrom. This quantity bears a relation to the estimated number of points profit. Figure charts affords a mean of judging this relation and hence frequently indicate the approximate objectives of such campaigns. If a stock is below value and these interests see a large profit ahead, they will take all they can buy at certain levels, then gradually raise their bid prices until they get all they want. Between the letters A and R shows this graphically. They buy preferably on reactions until such time as they are ready to mark up the price. Or if a stock is above value and they see trouble ahead, they will sell all they can at certain levels, supporting the price on reactions and unloading on rallies until they are ready to let it drop. This is why these support points and the points of resistance, a phase originated by Wyckoff, are so important for you to watch. In brief, when we see strong support in a stock with the rest of the market weak, we know the buying is better than the selling. That insiders are probably doing the buying because they believe they can sell out later at a profit. And when you see the reverse, that is a strong resistance in a stock with the rest of the market advancing, you know the selling is better than the buying. Insiders are selling because the outlook for that stock is turning sour or because they believe they can later reaccumulate at a lower level. When you see these indications on the tape or on your charts, follow them. That is, select the best of them if there are many. To do this is to have the insiders working with you and for you. You are then playing the game as they play it. This is not a guarantee of profit, but if your judgment be good and you choose the right time for action, you will find that you can realize a profit in the majority of instances. When an individual stock in any group is stronger than the average of that group, this is an indication that such a stock is likely to move sooner and faster than the average, provided its behavior confirms the indication. If it is weaker than the group, this may signify that the stock is preparing to decline more rapidly than the average. The fact that an individual stock may be moving against the trend of its group does not destroy nor impair the value or effectiveness of the indication given by the average in which it is included. On the contrary, such action of itself frequently conveys significant information which should not be ignored with respect to the behavior and position of that stock. In like manner, by comparing the behavior of the various group averages with the action of the whole market, the way they respond or fail to respond to advances and declines, rallies and reaction in composite averages, you may gain valuable additional information on which to base your stock market campaigns. These comparisons are especially important because they help you to select the best opportunities and to avoid the slow movers, the sleepers, thereby keeping your capital working at maximum efficiency. Bear in mind that all stocks do not move at all times in harmony with the prevailing trend, nor do they rise and fall together. Bull markets usually begin with advances in the leaders, that is, the seasoned, higher grade, higher priced issues. This is so because the big interest who are best informed as to prospect for approaching recovery dominate the stocks and hence reflect their sentiment towards the market by their operation in the leaders. The rise in the leaders continues. Large independent operators taking their cue from the action of the leaders are encouraged to begin bullish operations in the secondary issues and specialities. Due course, the public is attracted by bullish demonstrations in various parts of the list and by the revival of market activity, whereupon the lower priced and more speculative stocks come into line. Thus, demand rotates from group to group, as for instance, from steels to rails to copper, etc., and from one stock to another. As the rise progresses, individual stocks and groups of stocks that have advanced too rapidly may rest and react while other stocks and other groups are brought forward. Thus, bull markets are built up by a process of rotation. That is, demand shifts from week to week, day to day, and even from hour to hour. Price movements tends to become increasingly selective after a prolonged advance because when the big follows see that some industries have almost attained maximum prosperity, they will wind up their speculative campaigns in those groups and turn to those laggards in which there is still room for improvements. When large interests are distributing at the tops of the intermediate or major swings or on the way down from the extreme highs, they sometimes fool the public by rapidly marking up the prices of a few easily influenced stocks or by applying hypodermics to a few of the leaders. This whooping up tactics maintain the atmosphere of bullishness so essential to keep the public in buying mood while other stocks are being unloaded. See action of US Steel in March 1937, which exemplifies this principle. An indication that demand is being exhausted may be given when the majority of the stocks respond sluggish to such whooping up maneuvers, or when they tend to fall back quickly on repeated attempts to continue the process of rotation, or when the leadership of an advance shifts from the recognized leader to secondary issues and to the cats and dogs, or when representative stock fails to follow the strength in a few hypodermically stimulated fast movers. The process of rotation operates in much the same manner at the beginning and during the course of a bear market. That is, supply rotates to break down prices in one section of the list after another until offerings are finally exhausted. Likewise, selling pressure rotates when the market is in progress of forming a bottom. Hence, some stocks may reach their downward objectives sooner than the others. Therefore, when we see that the early leaders of a decline are refusing to move materially lower while supply is still rotating to other stocks, we have an indication that demand is overcoming supply. This helps us to determine the level at which accumulation is taking place. Supply in the falling market rotates more rapidly than demand in the rising markets. This is explained by the fact that there is seldom, if ever, sufficient buying power to lift all stocks at once in bull movements. Whereas in bear movements, fear, necessity, or both eventually compel holders to liquidate all stocks without regard to value. This characteristics difference may easily be seen by reference to the accompanying charts. Another reason why stocks fall more swiftly and uniformly than they advance is that the public long interest is always greater than the public short interest. Most people are willing to buy stocks but fear to sell short. Although intelligently conducted short selling operations often lead more substantial profits and involve no greater risk than commitments on the long side. At any rate, those who are long of stocks greatly outnumber those who are short. Consequently, upward price movements are retarded by frequent profit taking on the part of the numerous bulls, especially in stocks below the $50 class, which attracts the largest outside following. But downward movements are not so effectively retarded by profit taking on the part of relatively few bears. And because the public's attitude is unbalanced, leaning always towards the bull side, actual and potential demand for stock is greater when the market goes up than when it goes down. In other words, the majority will buy market is strong, but this demand fades away when it is weak. In fact, the untrained traders and investors hangs on to his stocks through failing markets until prices reaches a point where hope suddenly evaporates. Then he sells out in a panic. The herd psychology that characterizes the Wall Street public often causes unskilled investors to reach this panicky state of mind simultaneously. Thus, there is a concerned rush to sell, which cleans out all of the weak holders at about the same time, relieving the market of pressure and reducing the supply quickly at that point. The principles of rotation is operative also in group movements. The strength or weaknesses in the lending stocks of a group influences traders to buy or sell other stocks in the same group. This helps those who are conducting a campaign of accumulation or distribution to work their stock to the lower or the higher level at which they wish to acquire or unload their line. At the turning point in a falling market, the continuing weakness in other stocks creates the atmosphere of general pessimism, induces the public to go on selling around the bottom. This affords large operators an opportunity to buy what they want without bidding price up. Similarly, at the turning points in a rising market, the rotation of strength to other stocks in the group enables the large operators to unload the one he has marked up to its objective under cover of the activity and strength in the other issues without forcing his offerings upon the market. This explains why we so often see individual stocks in a group topping out or rounding out a bottom, one after another, and why all stocks do not necessarily touch their highs or lows together on the same day or on the same week or perhaps the same month. It likewise explains why some of the leaders of one phase of a bull market may not lead or actively participate in its later stage. You must strive to take advantage of the above principles. Seek out the stocks in the strongest position when buying and the weakest to sell short. Aim to pick the leader of a group for your operations. It is mistake to trade in laggards in a group simply because the leader is too high. Compare the action of Crucible and US Steel with Republic and Otis. Some of these other stocks may be in preparation for moves which will come after the leader is finished, illustrated by American rolling mills between October 24th and November 14th. That gives us an opportunity to switch from the leader when you see it maybe near the end of its swing to the next best issue or issues, that is, to those which may not have come fully into the line with the advance in the leader. But in searching out these opportunities, you must be sure to weigh each situation carefully. The fact that a stock is moving sideways around a low point while others in the groups are going up is by itself no assurance that this laggard must be under accumulation. Study its volume behavior. Note particularly whether the price shows a tendency towards rising support, as in the illustrations between M and S, for example. After it has been in the range for some time, if it does not show such tendency, better leave it alone. A stock that persistently hugs a low line of support, stays near the bottom of an apparent range of accumulation, and refuses to rally when the rest of the market is strong is very apt to be subjected to a shakeout. See study of Anaconda, or it may be a weak position. Therefore, bear in mind that even though a group may be in a strong position, every stock in that group may not be desirable, nor in a position to move aggressively, vice versa, in a weak group. Some stocks may be in a relatively stronger position than others, while some may be neutral. Some people endeavor to compare strengths and weaknesses by working out the relatively daily gain or loss in percentage to secure a ratio or index number. This not only involves unnecessary laborious calculation but creates the danger that you will acquire the habit of using mechanical methods, thereby defeating your purpose, which is to develop judgment. Moreover, such schemes are neither sensitive nor reliable. Judge the progress of stocks and compare strength or weakness directly from your chart as herein examined and as shown by the more detailed instructions which follow. From your vertical charts, you can see immediately by casual inspections how a stock is behaving in relation to the general market averages and in relation to its own group. Changes in its action become apparent at once so that you can adjust your conclusions promptly. You do not have to wait until some impractical, complicated mathematical formula is worked out. In any case, your formula is likely to be upset or contradicted when it is too late for you to act to the best advantage. The correct way to spot a change from comparative strength to weaknesses or from a comparative weaknesses to strength and to judge whether a stock is behaving bullish, bearish or indifferently in relation to the market as a whole is to observe how the stock responds to up and down swings in your composite average and group average as you make new entries of these price movements on your charts from day to day and week to week. For instance, turn to chart of electric auto light, covering the page with a blank sheet of paper, so that the plottings may be exposed one day at a time. You will observe that this stock shows a strong advance to July 12th, during which it rises more aggressively than the market as a whole, as represented by the Dow Jones average of 30 industrials. This is followed by a period of consolidation a normal reaction on July 25th, halfway back to the July 1st low. On August 12th, ELO leads the market to a new high with a quick markup. A reaction to August 20th brings the average down to lows of August 2nd and 8th. But ELO here gives a significant indication of comparative strength by holding above the lows it recorded at that time. From here on until it reaches 38 3 by 4 on October 21st, the price rises consistently to new highs with every upwave in the averages. But what is especially informative from the standpoint of comparative strength is the stock's refusal to participate fully in reactions in the market as a whole. Note particularly the ascending line of supports, low point after it leaves the August 20th low. During the sideways movement of September 12th to October 1st, which at first glance has the appearance of a range of distribution, the stock signals further strength to come by rising to a new high with an upwave in the average. Thus, on October 1st, it moves into new high ground while the average is rallying to a lower top. Thus, bullish indication is confirmed when the down wave of October 3rd fails to follow the average under the reaction low of September 20th and the price holds instead at a higher support. 29 1 by 8 compared with 28 3 by 8. On October 21st, a new phase begins. Here, after a quick run up to a new high, there are 6 days of hesitation and a narrowing of the daily price range, followed by a quick dip to the October 31st, which is comparatively more extensive than the reaction in the average to October 30th. This change to comparative weakness is confirmed by a sluggish rally to lower power on November 7th. In the phase of the rise to a new high in the average, electric auto lights responsiveness to strength in the market then continues poor until November 26th, at which time a change to strength is indicated by the leveling of the low points, November 22nd to December 2nd, while the average at the same time is recording a series of steeply descending bottoms day by day. Now compare the graph of Procter and Gamble (PGM) with the industrial average and with ELO. You will see immediately a contrast between a comparatively strong and a comparatively weak stock. From July 1st to 23rd, PGM moves in harmony with the market, but after sitting down to complete a normal reaction to 51 on August 20th, it drifts sluggishly in a small range without appreciably lifting power, which other stocks such as ELO and the markets are steadily advancing to. These September highs. Since July 23rd, there has been little to indicate a decisive trend in PGM on the basis of comparative strength or weakness. Expect the fact that following the corrective reaction to 51, the stock has failed to behave as well as it did in July, and now it is not responding readily to the bullish action on the average. This at least cautions us to become wary on the bull side of PGM. When the general market reacts between September 18th and 20th, we observe that PGM has developed a more definite symptoms of weakness in that it responds promptly by becoming active on the downside. Note the widening spread of the daily range from high to low. Between September 21st and October 3rd, the stock gives another bearish indication because whereas the average ELO and other leading stocks complete this reaction well above their July and August supports, PGM now is almost back where it started from at the beginning of July. From here on, PGM shows very little rallying power, but rather a marked tendency to remain dull and sluggish around its August, September, October bottoms at 51. Notwithstanding a steady new advance in the average, with the stock in this position, we must recognize that there is a danger it will develop new weaknesses, or it may be subjected to a shakeout. A brief but a weak 3-day bulge to a lower top, October 21st to 23rd, marks the final attempt to rally away from a danger zone and makes the picture very ominous for the bulls in this stock. Compare with action of New York Times average. And the immediate loss of this gain in the next 2 days is an otherwise strong market. Says, get out now if you didn't do before, and sell me short if you are inclined. Applying the same line of reasoning to the chart of commercial solvents (CV), we see that here we have an illustration of a stock swinging at random and hence in a more or less neutral position. In other words, judged by the factor of comparative strength and weakness, CV shows no evidence of developing any consistent trend. Thus, after an abortive run, July 1st to 23rd, the stock alternates from moderate weaknesses, July 24th to August 8th, to stability, August 9th to September 4th, to mid-rallying power, then to weaknesses, to stability, and to back to temporary strength, and finally to a neutral position again in late November and December. In order to demonstrate how the principle of comparative strength and weakness may be applied in a practical way, let us now assume that it is early August 1936 and that CV, ELO, and PGM are the only stocks we are keeping under observation at this time. Assume also that we are just entering the stock market and have decided to take a long position. Say about August 1st. Obviously, on the basis of what our chart shows us, as above outlined and without consideration of any other factors whatsoever, we would select ELO and PGM as logical purchases, but we would have nothing to do with CV. As the days go by, our observation of the comparative strength and weakness of these stocks tells us to stay long of ELO until October 21st, to close out and be neutral towards PGM not later than September 19th because it is not acting right, and to continue to avoid CV. From the above study, you can see how the factors of comparative strength and weaknesses oftentimes is highly informative, aiding us 1. To select the best stocks for our purpose and avoid the wrong ones. 2. To detect turning points, thereby enabling us to time our purchase and sales to the best advantage. And 3. To determine when preparation for a worthwhile move up or down is about completed. Our next set of graphs should be analyzed in the same way, but the particular point we wish to bring out in this illustration is the principle of rotation. Thus, note how the oil and rubber groups starts upward above January 22nd, moving in harmony with the general market times average until February 11 to 14th. Rubbers then react while the rotation of demand to other groups, as for instance, the steels and chemicals, holds the times average in the range 119 to 122. Meanwhile, preparation for an up move continued in the steel group a week longer to about January 30th, while oils and rubbers were being marked up. Next, as oils and rubbers begin to meet resistance to the advance, demand shifts aggressively to steels between February 10th and 18th. Oils and rubbers complete their reactionary movement simultaneously on March 9th, 4 days ahead of the times average. We take particular note of this, that is, the ability of these groups to hold around and above the low point of February 25th, while the times average is still sliding down to the March 13th low and a little under the February 25th support, because such action not only gives an indication of comparative strength in oil and rubber but implies also that they are likely to be among the leaders in the market's next swings. That is, provided their action otherwise in conformity with the inference drawn from this one factor of comparative strength. Likewise, refusal of oils and rubbers to participate fully in setback to March 14th, that is, their tendency to react reactively less than the market, helps us to diagnose the break in the average from March 6th to 14th as a technical corrective reaction rather than the beginning of a bad trend. In other words, our reasoning at this point is as follows. The composite average did not give indication of extensive distribution on the rise to 124, and our studies of our other records generally do not indicate anything more than the probability of a corrective reactions in the market. Therefore, we conclude that the relative strength in oils and rubbers should be interpreted to mean that these groups are being supported or reaccumulated under cover of the rotation of offering in other groups, as for instance steel, which are still being allowed to react. And we conclude further that the comparative strength of these groups, March 9th to 14th, probably is the forerunner of a turning point in the market as a whole. A turn that is likely to come when other groups have completed their reaction in sufficient number to place a predominating percentage again in bullish position. In late March and early April, there is a significant change, the above conditions being to be reversed. Thus, oils are failing to make appreciably progress as demand rotates in that group from March 19th to April 7th. A further indication of increasing pressure appears when they respond hardly at all to the March 31st April 6th run up in the times average. Exhaustion of demand in the oils is confirmed when the group averages starts downward April 9th, while the composite average, the steel, rubber and other groups are still steady, strong or advancing. But as demand continues to rotate, we observe that these other groups also respond sluggishly to upward impulses, bearish implications. Steels falter and react a week ahead of rubbers, having meanwhile been subjected to what looks like an amplification of hypodermics. The fast markup from April 1st to 6th, evidently designed to facilitate the distribution elsewhere. Rubbers continue to make steady progress, rotating to a new high a week later than steel and oils. And after those groups have already started downward, their last strength in the rubbers helps to hold the composite average well in the distribution range 126 to 123 to give the market the appearance of strength when actually the support underneath has become hollow as a result of the active rotation of supply from oils to steels to rubbers, etc. Successively and finally, the increasing weight of this selling pressure precipitates a general collapse, terminating April 30th. Then the whole process starts over again, and by studying our charts carefully, we are able to single out the stronger from the weaker stocks and group of stocks as before by watching to see which ones offer the strongest resistance to the decline. Thus, we see that the rubbers, for example, react relatively much less than oils and oils less than steels, etc. The graph on screen shows the advantage of comparing the action of an individual stock with the average of the group to which it belongs, as well as with the composite average. In this instance, note particularly how Auburn's failure to participate fully in group strength and its inability to respond as aggressively as before to a fresh upward surge in the general market during the week ended April 4th emphasizes the development of significant weakness and the weak character of the final rally to 51 3 by 4. This marked a decisive change in behavior compared with the previous performance. About April 4th, the stock is on the hinge at 50, and the outcropping of acute weaknesses becomes pronounced in the next four sessions, showing that the stock is on the springboard for an important slump. Distribution in the range 46 to 54 evidently was thorough, since AAC continued extremely sensitive to reaction and highly indifferent to rallies in its group and in the market, even after the excessively severe slump to April 26th. On screen are presented two classic examples of weak stocks in a strong market. Note especially how the factors of comparative strength and weaknesses reflected the bearish behavior of Penick and Ford in spite of its thin market and daily small turnover. Volume was generally less than 500 shares daily and only reached or crossed 1000 shares on three occasions during the 6 months period shown on the chart. As you study these charts, remember they are intended only to illustrate some typical cases. They should not be regarded as covering all possible conditions nor be used as exact standards of comparison. In brief, do not make the mistake of attempting to classify chart formation according to mechanical rules with the idea that you may discover automatic buying and selling signals from similar patterns. You are being deluded if you believe that a system of drawings, triangle, head and shoulders, and similar imaginary geometrical diagrams on your charts will produce results or relieve you of the necessity of employing judgment and sound practical reasoning. One other word of caution: comparative strength and weaknesses is a very valuable means of determining a stock's position and possibility, but this principle must be used with regard to the other contemporary technical manifestations to be taken up in following sections.